Hey everyone, today I will introduce you to stocks and stock markets. Let's do it. As you know, a stock is a share of a company that you can buy. It is very useful for many reasons. For example, with already a small amount of money, you can already have a share in a company. That share is obviously very tiny, but still you own a little bit of, for example, Apple or Tesla or Google.
For companies, it's very useful because they can obtain financing that way. Also, if a person founds a company and grows it, and then at some point they want to cash in, this is also a really good way to do so. If you think of Facebook, for example, Mr. Zuckerberg founded the company I would say in the early 2000s or so. It was a couple of years ago, 2015, or when was where he did the IPO, and ever since you can buy Facebook stocks on the stocks market. So that's how he could cash in, for example. There are also a link between the financial works and the real economy. And through the stocks, it's very easy to say what's the real value of a company. All you need to do is just take the price of a single stock and multiply it with the number of stocks that are out there, and that is essentially the value of the company. So very nice and simple. And it also helps us to allocate scarce resources. As usual, the price is the mechanism that is essentially signaling where the resources are supposed to go to. So sometimes you hear instead of stocks, they might be referred to as common stocks or equity. As I mentioned, it's a share of ownership. The story of stocks is actually pretty interesting. If you look into internet, I recommend you when you have some time, look into the history. It started back in the 16th century as a way to finance voyages of explorers. They would go back then. They would, especially the Europeans who were big in sea voyages. They would send their ships to all over the place in South America and Asia and Africa, and they would do trades. They would bring exotic products and goods, and it could be potentially very profitable with the profit of those goods. It could have been as simple as exotic spices or something like that that they would bring from India. The problem was, however, that it was also kind of dangerous. You send the ship out, it takes months, if not years, for the ship to come back from the voyage. All kind of things could happen, obviously. There could be bad weather that makes the ship maybe not come back. There could be pirates, etc., etc. So there was a high risk and high profit that you would be facing, and of course that voyage is also not cheap. So for a single person or a single company to invest in those voyages, to make the risk reasonable, you would need essentially to invest in several ships at the same time, so that if one or two of them don't come back because the ship sinks on the way, maybe they get robbed by pirates and things like that, that you make up for those losses with the profits of the other ships. Now, as you can imagine, back in the 16th century, there were not many individuals or companies that could afford to send, several of big ships on a voyage. So that's why they came up with that idea of pooling essentially money, selling shares of a company that sends ships out, so that people with less money can buy just a share. And that share would entitle you to have a percentage of the profit of the several ships that would go on voyages. So this is a way to spread the risk through the joint stock company. They would issue the stock and use the process to finance several expeditions at once. And in exchange for that, the stockholders would receive a share of that profit. Now that sounds like a good idea and was by itself an idea that made sense. It yielded, however, in the 1700s to a bubble that was called the South Sea bubble. That was had to do with a company that had the name South Sea. The company was making most of the voyages to South America, and the stock prices, it yielded into a hype and then a bubble, and the bubble burst. The South Sea bubble is not even the first bubble that we had in the history. Another one is the tulip mania in the Netherlands, where for a rare tulip the price was more than the price of a single family house back in the days in Netherlands, which is insane. So it was something like 10 years salary of like a carpenter or something like that for a single tulip. So there are a couple of bubbles that were out there, and the histories are interesting. I do recommend you to look into that, read a book, or watch videos about them. It's pretty interesting. As we understand by now, shares are issued in small denominations. So one stock is a small denomination of a company. So some companies, larger companies out there, they have tens of millions of shares or hundreds of millions of shares out there, which is pretty huge. And then the shares are transferable from an owner to another one. So that's why you have the stock exchange places where you can buy and sell those stocks. You transfer the right to someone else and you receive money for that. And yeah, just like bonds, you used to get actually a stock certificate when you would buy a stock. And nowadays, if you buy stock, you don't get a certificate anymore. It's all electronically computerized. It's all bits, zeros and ones, essentially. But my grandfather, when I was a child, back then, I remember he told me that, when he would buy stocks, he would actually receive like the certificate a couple of days later mailed or something like that. So it was a thing back in the day, so in other countries as well, not just in the United States. So anyway, the ownership brings you rights. You have, on the one hand, you receive a share of the profits in the form of payments, and that thing is called dividend. On the other hand, each company has an annual meeting. As the name is suggesting, it happens once a year. And if you have shares of a company, you're entitled to participate in that meeting and also vote for certain things, for certain decisions about the company and so on and so forth. We'll talk about that also later. Another thing to keep into consideration when you own a stock, in case the company that you own the stocks from goes bankrupt, you are merely a residual claimant. What it means is that when the company goes bankrupt, everyone else to whom the company owes money is served before you. So in other words, probably the very first person or entity that gets the money from the stock is the government, in the sense that if the company owes taxes and goes bankrupt, when they liquidify the company, first thing they do is from that money they pay all the remaining taxes that the company is owing. Once the taxes are paid, then all the other entities in the legal order that they're supposed to be served are paid off. And if after all of that, if there is still anything left, then the stockholders are being paid. So they are paid last. So I can pretty much guarantee you, if you own a stock and that company goes bankrupt, no one is paying you anything. You can forget about that money. That's the downside. But on the bright side, it's limited liability. The most that you will lose is the money that you invested in that stock. So it's not like some other types of investments or companies where you buy in and they might come and take away your house or your car or whatever else you have that you would have to liquidify to pay off the debts. You are not responsible for that. If you buy stocks of a company, you cannot lose more than what you paid for the stocks. Now, so it has some benefits, and that's why the markets thrive for several reasons. Here they are listed again. The share is just a small fraction of the company's value, which means that, for even if you even have small amount of money to invest, you can that's already enough to buy some stocks of a company. There are many number of shares are outstanding. It's a very liquid market, especially if it's a larger company. You can buy and sell stocks within seconds. So you can get your cash back very fast usually. That's nice. The prices of individual stocks are usually low. That's not true for every kind of stock. So there is the most expensive stock in the world is Berkshire Hathaway. The price of that stock is a couple of $100,000 actually, because it was a very successful company ever since Mr. Buffett started that company in the 60s, I believe, in the 1960s. And he was extremely successful, and his success, was resulted into a higher and higher stock price. And he was against stock splitting, but because he never did this stock splitting, the price is that high. And also shareholder, in that annual meeting, you can also replace managers. If you are not happy with the job of the managers and the stockholders vote for a change, they can actually absolutely do that. They can fire the manager or also like the board of directors and things like that. So it is interesting.
That's it for today. Thank you very much and have a great day.